Let's bring in Alan Nuckman, Chief Market Strategist at Agora Financial, who's live from the CME in Chicago. Alan, almost surprised that in the light of, or in the face of these escalating trade tensions, that we're not seeing more volatility in the market. Do you think this low level can last? What do you think? Just talk us through some of the trading that we've been watching for the VIX index.
Well, we saw a bit of a bounce here today, and most of it came in the afternoon when it was announced by President Trump that he was going to have something to say after the close. So what we've been seeing, this is a repeated pattern, is you see sell the rumor, and then later on people buy the fact when they realize it's not as catastrophic as it could have been. So that's been the pattern for many weeks now, many months, as these news announcements come out. If you look at it 48 hours later, most of the times it's been shaken off. And this, like I said before, has been a shake it off summer where the market's been able to shake off all of these potential, crisis and continue to, march and make new highs and get back all the losses from February. So let's see what he has to say, but we saw the VIX bounce a little bit here today. It's still at a very low level, but we're back inside that range where we're trading between 10 and 15, and that's kind of what we did before that February VIX-plosion spike that we saw. For about 8 months prior to that, we were in that range as well. So the pattern still remains intact where stocks move higher and the VIX moves lower, so let's see how it responds by the end of the week.
Yeah, so look, the ongoing trade tensions, I mean, this is obviously the headline for markets right now, whether it be positive headlines or negative headlines. The market is so hypersensitive to anything that's going on. And it certainly has put a bit of a pause on the stock market recently, despite a pretty positive backdrop against earnings or against the underlying US economy. How problematic do you think this trade war will be or could potentially be for markets?
Well, it gives us something to talk about every day. It seems like there's another iteration of this every couple of days. But, truth be told, the way that Trump has positioned himself is that with more tariffs, they were essentially going to, be in position to put a tax on every single import from China. So that's kind of the worst case scenario. I mean, this is a full-blown trade war, and look at where the market's at. We're still hanging out near the highs. Coming into today, we were 2% away from the highs in the Dow, and the Dow has been the worst of the big three indexes, and the S&P was a handful of points away from those all-time highs. So for me, it's more important to see how the market acts and reacts to this. And so far, like I said, the markets have been able to shake this off so far this year and continue to move higher because fundamentals are so strong, corporate profits are so strong, and corporate profit growth is what's driving this market.
I guess at the end of the day, no more tariffs is probably the best outcome, but it looks like that's not going to happen because Donald Trump is taking quite a hard line. So maybe the 10% is much better than everyone had feared. Why the tech stocks? Why have they been caught up in the big sell-off today?
A little bit of unwind. They had bounced back and kind of made a mini bottom here in the last couple of weeks. Let's remember what we did last week. We were up about 1.5% in the major indexes. So we did have a bit of a bounce. But you get these ebbs and flows of money in and out of that tech group. And one thing that I'd mentioned weeks ago that what I'm looking to see happens next is how Facebook reacts. Now we were just at the highs here recently without Facebook. So that's a pretty significant psychological stock in that basket. And so if they can kind of shake off their woes and stabilize after this sharp sell-off that we've seen, that could really give that market a get up and go if it stops being a drag. So again, today we're down just a bit, giving back some of last week's gains, but you have to expect volatility in those tech stocks. I mean, a perfect example is AMD. AMD had gone up more than 100% in just a couple of weeks, Advanced Micro, and then last week it rallied 6% and then dropped 5% within the same session. So you're going to see some volatility, but again, as a trader, we want to see the markets move. And the S&P is really kind of stalled out. It's been a long time since we've seen a closing move plus or minus 1% in the S&P. So we've seen kind of a stall in the overall markets. But like I said, as a trader, we want things to happen, and it's our job to pick out those opportunities.
So do you still get the feeling that the market wants to go higher from here, looking at the trend lines and looking at some of that technical analysis?
Yes, absolutely. My song's not going to change, and we've been singing this for the last 8 years. And until the fundamentals change, until interest rates rise, let's talk about the most important thing that I think that is getting neglected here is the dollar index. The dollar index on Friday hit a 6-week low. So we've got a blow off top in the dollar. Now, what's happening in the underlying current here is the dollar had bounced in 2018, contrary to the straight down move that we saw in 2017. Now, that had kind of slowed some of the commodity stocks. Obviously, you're very sensitive to that in Australia, and some of the resources. Now, with this dollar top, that can help out those sectors make a bit of a comeback. We're seeing oil, obviously, right around the $70 a barrel level. We've seen gold stabilize around $1,200 an ounce. So I think some of the worst may be over there. Let's talk about the dollar specifically. Looking at the futures markets that trade over my shoulder here, the short-term interest rates, those are determined by the Fed. We're going to get a rate hike in September. There's no if, and, or buts about that. You never say for sure, but this is a for sure 99% probability that there's going to be a quarter percent hike, and there's a 1% probability there's going to be a 0.5% hike. So it's pricing in 100%. Now, there's going to be a rate hike in December, then another rate hike in March, and another rate hike in June. But then it stops. Then if you look all the way out to 2022 or 2023, there's no rate hikes from next June, therefore forward. So that's been priced in. I think the dollar had been thinking that rates were going to continue to go higher, higher, higher. And now, if this is what the market thinks, I think maybe the dollar can relax, and that would be very helpful to a lot of stocks and a lot of commodity sectors. So I think that's the big catalyst that we want to keep an eye on.
What about the move into safety? I note that today during the session we were watching some of those energy plays getting a bit of a bounce, in particular ExxonMobil, even some of the industrial stocks, the likes of Caterpillar and Boeing. We know that they have been trade-related or trade-sensitive stocks. I mean, how do you play the situation that's going on right now in terms of positioning a portfolio to take into account perhaps an escalation in those trade tensions? Do you move into some of those sectors that offer more of a safety play?
Well, I think a lot of those stocks had already priced in concerns about the trade, war developing, and we have one. There's no doubt about it. But looking at some of those big Dow stocks, I think the key thread that you pointed out is that they're all big dollar Dow stocks. The Dow has lagged behind the indexes, and it did get to its highest level since January, but still unable to take out that all-time top. So there's still some more upside in the Dow that's been begrudgingly moving higher. So some of those big dollar Dow stocks still have a lot more upside in those. Exxon, Chevron's a better example than Exxon, I think, to play a little bit of catch up. Exxon's broken out above the 84 level of 85 and made a nice bottom and a bounce, whereas Chevron's still negative on the year. So I think those tend to move in tandem if you can look, longer term. You talked about Boeing. Home Depot recently made some new highs. So some of the big dollar Dow stocks, let's remember, only about half of the Dow stocks are positive on the year. So there's some upside potential there as far as, the flow of the overall market, that those are going to offer some better value than some of the other stocks that have been up and away.
Alan, just finally, and looking outside of stock specific, more around the globe, because emerging market currencies have been under a lot of pressure. Again, through the session, we were watching India's rupee, South Korea's won, Turkey's lira, all continuing under pressure against the backdrop of these escalating trade tensions. The Shanghai Composite, its lowest level in nearly 4 years. The Hong Kong benchmark has recently reached, bear market territory. Again, yesterday, South Korea's KOSPI was lower. So really, a lot of those Asian markets, the emerging markets being caught up in all of this, do you think they will continue to underperform? Could they be the catalyst perhaps for the next downturn in global markets?
I don't think so. I'm a buy low guy and then see how they respond. And we've seen over the years that you see value at times when markets get overdone to the downside and everyone gets overly pessimistic. And I think this may be the case for China as well. China is obviously down significantly, 15%, as compared to our stock market being up 8% or so in the S&P so far this year. So I think from a risk-reward standpoint, I'd rather be a buyer. When you get back to these emerging market currencies, they got hurt, and they do get hurt by the strength of the dollar. Now, if that dollar strength has waned, then I think that they may offer some recovery. But again, these are perfect examples of, stocks or sectors that have been down. That's the time to be looking at them. That's the time to be positioning for 6 months, 8 months, a year out, and see how they can respond. A good example, Freeport-McMoRan, a copper play. You're obviously very familiar with the mining and metals. We're basing out here, and we saw some bullish divergence, meaning it made new lows, and then it had the volatility did not make new highs. So that's usually how bottoms get put in, as a short squeeze can happen and turn this market around. Let's remember, overall, I have to be still bullish no matter what has been happening around us.
All right, excellent. Look, Alan, on that note, we will leave it there. Leave it there on that positive note as always. Thank you so much for joining us. We'll talk to you next week.
Thank you.